All right, in a previous video, I explained that there's 5 different types of accounts. There are asset accounts, liability accounts, income accounts, capital accounts, and expense accounts. If you're not familiar with the individual types of accounts, go back and watch that introduction to Alice video. And I go through each of those types of accounts and talk about the different account names that are within each of those. So each account, for example, cash is an account. So cash is an example of an asset account. Every account, whether it's cash, whether it's service revenue, which is an example of an income account, whether it's rent expense, which is an example, obviously, of an expense account, every single account has a left side of the account and a right side of the account. The left side of the account we call the debit side, or DR for short. The right side of the account we call the credit side, or CR for short. The reason why the DR is there because debit is short for debenture. So the first thing that I need for you to understand is that debit means the left side of the account, and credit means the right side of the account. What it does not mean, debit does not mean plus, and credit does not mean minus, or vice versa. Debit just means the left side of any account, and credit means the right side of any account. Now, what's confusing to some students, at least initially, is that some account types get larger when we make entries on the left side, while other account types get larger when we make entries on the right side. So that's why I put the 5 different types of accounts in an Alice, A-L-I-C-E, like a girl's name. And what I'm going to do is I'm going to make a little chart here, and I'm going to put a DR, and a CR up here for debit and credit. So what happens, and the rule is that all asset accounts, so cash, land, buildings, computer equipment, all asset accounts get larger when we make entries on that left side of the account, or when we debit them. Expenses are the same way. Expense accounts, rent expense, salary expense, utilities expense, supplies expense, depreciation expense, all expense accounts get larger when we make entries on the debit side, or we debit them. Liability, income, and capital accounts all get larger when we credit them, all right? When we credit them. And so the mnemonic, which is the title of this video, is Alice, A-L-I-C-E, goes to D.C., like our nation's capital, and gets pregnant, right? And it's just a way for you to remember on which side do particular account types get larger on. So, but it does more than that. This mnemonic also tells you what their normal balances are. So if someone were to ask you, what is the normal balance of a cash account? You would think, well, cash is an example of an asset account. The normal balance of an asset account is a debit balance. Someone were to ask you, well, what's the normal balance of service revenue? Well, you'd say service revenue is an example of an income account. The normal balances of income accounts are credit balances. If someone asks, what's the normal balance of rent expense? And you would say the normal balance of rent expense is a debit balance. So again, this tells you not only how they get larger, but also what their normal balances are. Now, of course, if you know how they get larger, then you can also figure out how they get smaller, right? So cash, which is an example of an asset account, gets larger when we debit it. It gets smaller when we credit it, right? So when you write out a check for $100, your cash goes down. Cash is an asset. You would credit that $100 in the cash account, okay? If you received $500 from a customer, then you received cash $500, your cash goes up. You would make that $500 journal entry, or the $500 entry on the left side of the account, the debit side of the account. And we can kind of go through that way, the way that if you incur some liabilities, accounts payable, your accounts payable goes up, your liability goes up. We're going to make that entry on the credit side. When we pay down the liability and the liability goes down, then we are going to make that entry on that side of the entry on the left side. Now, the other thing is all debits, everything that you do on the debit side, you also have to do equally on the credit side. So you have to have equal debits for equal credits. So if you're debiting an account, say cash for $100, right? And so let's say you do some work. So you put $100 and you receive $100 from, let's say, a client who gives you $100 of cash. Cash is going up, so you would debit an asset account for $100. Well, if you debit something for $100, you have to credit something for $100, and the account that you would credit that went up is an income account, probably service revenue or sales, depending on what type of business you are. So every account and every transaction, all your debits have to equal all your credits. But this is a way of remembering, well, what side does the account get larger on? And then also, what is their normal balance? Hopefully that helps out.